Since the outbreak of the U.S.-Iran war, oil prices have surged past $120 a barrel, with two-year Treasury yields rising in tandem. Markets are broadly betting that the Fed will turn hawkish as a result. But in its latest report, Bank of America presents a contrarian view. This investor Panduan could well be wrong. A supply-driven oil spike doesn't necessarily trigger Fed tightening. In fact, it could lead to significant rate cuts instead. BofA economist Aditya Bhave says the energy price shock throws the Fed into a serious conflict between its dual mandates of price stability and maximum employment, sharply increasing policy uncertainty. The current market logic, equating higher oil with higher rates, is flawed. In extreme scenarios, both tail risks widen: rates on hold for an extended period, a return to hiking, or outright deep cuts. All three are simultaneously on the table. Data show that short-term Treasury yields have risen about 20 basis points this month, while traders' expectations for full-year Fed rate cuts have narrowed from over 60 basis points to just 40, a clear cooling in hopes for easing. Although oil prices have pulled back slightly from their peaks, the Middle East situation hasn't calmed. Producing countries continue to cut output, and shipping through the Strait of Hormuz remains nearly halted. The foundation of the supply shock hasn't gone away. Pave stresses that the current macro environment is fundamentally different from the 2022 Russia-Ukraine conflict period. Back then, unemployment was lower, households were flush with fiscal stimulus, and the economy was better positioned to absorb high oil prices. Today, the labor market is already softening, inflation is modestly creeping up, and fiscal support has largely faded. If the oil shock persists, the drag on growth will be more pronounced, and the Fed may actually respond by leaning more dovish. This week, market focus shifts to the upcoming U.S. February CPI report. Consensus expects headline CPI to rise 0.3% month-over-month and core CPI to rise 0.2%. Citigroup economist Andrew Hollenhorst notes that after spiking, oil prices have eased, and the rise in two-year yields has correspondingly narrowed. Economic data will once again take the steering wheel. He points out that higher oil mainly lifts headline inflation. If the shock is short-lived, the pass-through to core inflation is limited and won't exert sustained tightening pressure on Fed policy. Taken together with oil surging, employment softening, and inflation flickering, the Fed's policy choice is no longer a simple hawk-dove toggle. BofA's view cuts against the market consensus, warning investors to brace for sharp asset price swings as expectations diverge. Against the gradually emerging shadow of stagflation, the probability that the Fed ultimately chooses to cut rates is rising significantly.